yes, the U.S. labor market actually is resilient, contrary to popular bear porn narratives. So what I'm showing in this chart are various categories of nominal disposable personal income. If you focus your eyes on the second panel, we have personal income. This is a compensation of employees received. That number accelerated in January to 5.2%. 3-month annualized. That is an above trend growth rate of compensation of employees received. This is the broadest monthly measure we get of income from the labor market in the U.S. economy. No one pays attention to it before 42 macro, but this is the data point that would have told you all of last year that all the bear porn you've been hearing on Zero Hedge and on podcasts about the U.S. economy and the U.S. labor market and the birth death model and all this other nonsense is just nonsense. It's clickbait. The people are trying to sell you ads. They're trying to sell you newsletter subscriptions. They're not trying to help you make money. They don't give a damn whether or not you make money in financial markets. We do. So that's why we do the 135 slides of research for you every month in these presentations. Let's get back on track. So the initial and continuing jobless claims can currently indicate a low probability of a developing recession. So on the top panel's initial jobless claims, the 4-week moving average there. The 3-month annualized rate of change of the 4-week moving average is below the recession signaling threshold for that time series. If you look at the initial continuing jobless claims, the 3-month annualized rate of change of that time series, so that is below its recession signaling threshold. So both of those are currently indicating a low probability of a developing recession in the U.S. economy. The 42 macro Fab 5 recession signaling indicators currently indicate a low probability of a developing recession in the U.S. economy. In fact, only one, temporary employment, is actually below its recession signaling threshold. So that's not good. But if you look at the Michigan Employment Survey, that's fine. The Conference Board Labor Survey differential, that's fine. Continuing claims total labor force ratio, looking at that on a 3-month annualized rate of change basis, that's fine. And then as well, cyclical unemployment 3-month annualized, that's fine as well. So again, we only got one of these indicators indicating a recession. So for now, we continue to say that even though the yield curve is out there, and we'll talk about the yield curve in the left tail risk section, because again, we're doing research about the full distribution of probable economic outcomes, and sometimes the modal outcome of the distribution is hard landing. But right now, the modal outcome of the distribution is soft landing. We expect the no landing to become the modal outcome of the distribution. And then maybe, I don't know, a year after that, who knows, the hard landing will become the modal outcome of the distribution. It's about understanding how the distribution of probable economic outcomes is evolving. And just as important as that is trying to understand how the market expectation of that distribution of probable economic outcomes is evolving. And that's why we have to do so much research every month. I can only do the modal outcome section and tell you what I think is going to happen. But it's very important, I think, as an institutional research process to understand where you could be wrong, and you could be wrong in both directions. And so we have to do that research so that we know when the market regime does transition, we're well equipped with the appropriate amount of research, the deep dive materials that we need to have conviction to react to a change in the market regime. If you haven't done the research, you're not going to want to react to it. You're going to be like a 5-year-old who's not getting their way in the toy store.